Hey everyone, welcome back to the Financial Freedom Podcast. Sam and Diana, we have a very special guest that we invited back to do another podcast with us. Last time we had lots of fun. So, um, Bilal, everyone, thanks for coming.
Thank you. Thank you for having me. It's a pleasure.
Yeah, awesome. Yeah, last time we had some really heated conversations about mortgages and the core equity program, and we just want to invite you back and just pick your brain a little. I know you guys do a lot of deals. You deal with a lot of different clients and in different situations, so you can definitely give us some insight on what's happening in the real estate and the mortgage world.
Absolutely, would love to. And yeah, the last time we had some good conversations, and the what all the topics that we talked about are so relevant now, even more at that time
That's
than
right.
that time. So I'm looking forward to it.
Yeah, for
I
sure.
missed
for
that
sure.
one, so I'm really excited to be here for this one. I had a little FOMO because you told me how amazing that one was, and I watched it. It was great. So let's just get right into it. What are you seeing in the market right now? I know like things have changed drastically from January, February. So
So yeah, a couple of things. Obviously, we know as when I was here last time, we called it at that time that they're going to be doing a rate hold. We talked about that date
Right,
in
for
March.
6th. Yeah,
Right, exactly.
March 6th.
So there was no rate hike in March, and as we had talked about that time, I said that this would add fuel to the fire. And
And it
and it
Wow.
did, right?
Yeah.
Fast forward, and obviously you guys are on the ground. You can probably talk about that more than me. But every realtor partner that I'm speaking to is, multiple offers, on everything. Especially, I think that price range, about the million mark.
Yeah, the entry level detached homes or freehold homes mostly, but
It's-
even the others.
even the other ones are going bananas. Like
Bananas,
it's
yeah.
But
yeah.
especially those 1 million plus detached homes.
Yeah, because again, it's all about optics, right? Like when people see the common man, when they see that, oh, there's no rate hike, the Bank of Canada has held a rate, right? That's what happened in March. That was our first hold. And then in April, there was another Bank of Canada meeting, and there was no more rate hike, right? We're going to do a pause, another pause, right? So as a consumer, your mindset goes like, okay, great. Like, now's the time. Like they're not increasing the rates anymore. So, they perceive that as positive news. And to an extent, it probably is, I would say. But the optics are great. And that's what we're seeing on the ground. And, we still have the same issues that we did when we spoke last time. Inventory is still not there. So that's what we're dealing with right now. Multiple offers. There's especially that price range is just going bananas, like you said. So
Yeah, and I've been saying this for a while. Like, interest rates are not going to solve our supply problem. We are lacking inventory. We have been for a long time. We need to build more homes, and I can't see them catching up anytime soon. But my question is, like, how are they qualifying people right now? Because, yes, there's low inventory. Yes, there's a desire to buy a home, but how are people actually getting qualified by the banks?
So interestingly enough, what we're going through right now is, and folks that are watching at home, they can look this up: quantitative tightening. That's the phase that we're in right now. So the banks, and it's mixed messaging, and this is the piece that we didn't talk about last time. So you have the governor of Bank of Canada, Tiff, Mr. Tiff, our good friend Tiff. He told us not to worry. Interest rates aren't going to go up. Not to worry, right? And what happened? We got 8 rate hikes last year, right? Insane. Now they're telling us in the last meeting, Bank of Canada meeting, he said that if you're speculating that the interest rates are going to come down, they're not going to come down, right? So then you're like, oh, okay, so they're going to keep going up. But then on the flip side, and I'm not going to name the name of the banks here, but the top 5 are pricing that into their strategies. So, they're already pricing in those rates. So the fixed rates are already starting to come down, right? So if you came to me asking for a 5-year fixed rate on, let's say, a high ratio mortgage, by the way, means when your down payment is less than 20%. I would have probably quoted you a rate somewhere about, for a 5-year fix, like 5%, 5.05, in that sort of range. Now what's happening is that 5-year fixed rate, we actually just did a deal 4.49. for a 5-year fix a couple of weeks ago. So the banks, they're already pricing in that the rates are going to be lower. So they're incentivizing clients to take a 5-year fixed, right? They don't want people to take variables. So they're trying to lock in folks into a 3, 4, 5-year fixed rates. So that's the tightening process, right? And then when you talked about how are they qualifying people, that's still there. So the stress test is still there. So whatever the contract interest rate is, plus 2%. That's what they're testing the mortgage on. So even though you're going to be, let's assume that your rate is going to be 5% for the mortgage, but the qualification is done at 7%. So assuming that if the rate was 7%. So it does make it difficult to qualify, no doubt about that. But at the same time, where I would probably agree with the system is that it's protecting our market. Yeah. I think
that's the difference between our market and the U.S. Like it's a lot more regulated.
So
U.S. is the wild, wild west.
Yeah. So hear this. I'm not sure if you heard the news. So this is a big one. So in the US, as of May 1st, okay, if you have a credit score of 720 and over, you're going to get a higher interest rate than someone that has a 620 credit score.
So they're penalizing you for keeping up with your payments.
Yeah. What's the reason for that?
So I think, and again, it's a political move, as the re-election is nearing. So, they're trying to appeal to the masses that, it's the socialist aspect of it. But it's and for lack of a better word, I personally think being in the finance world, I think it's absolutely ridiculous,
Stupidest thing I've ever heard. A lot of these things are more political than economic, but, that's.
But to your point about Canada, you said Canada and US. So Ontario probably even is the most regulated industry, probably I'd say in the whole world. Like the amount of regulations we have, no one else has. But that's a good thing because that protects our market from creating this bubble that could burst at any time. I bet you right now, I will, say this very confidently, that after their next election, if they do not reverse this policy, you're going to see a huge problem in the U.S. as it pertains to the real estate market. How can you expect someone that doesn't have good credit? There's a reason why they don't have good credit is because they made some, bad choices. They haven't made the smartest moves. That's why their credit score is not as high, right? So now you're incentivizing them by giving them lower rates, right? So they can buy more, they can qualify for more, right? And then you're opening yourself up to a higher risk of default. That's what happened in 2008, right?
Yeah. I mean, it's this whole like a little bit of just keeping people in their lane, keeping people low, so they're not able to succeed as much. I mean, it's crazy. I don't know how they're going to pull that off for long term, but what are you going to do?
So now when we're making this video, end of April 2023, and obviously since March 6th when they didn't increase the rates and they held it, and again in April, and we see the market kind of going nuts again and multiple offer and bidding wars. Is that making the banks feel more confident in the market? And do you think that's gonna, as a result of that, they might loosen up some policies or kind of get more?
So actually, the government, like OSFI, is actually stepping into a lot of these things now. So it's not making things easier. So for example, I'll give you two real examples that have happened recently. So number one, OSFI has said that you can no longer do mortgages with a 3-month bank statement program. So, for self-employed clients, we used to have this program where I could get you qualified with 3 months of your bank statements, business bank statements. We use your deposits on there to annualize what your cash flow would look like, and then, do a calculation of expenses. But we could use 3 months bank statements. Now they've taken that away. So it's minimum 6 months, right? So that's one thing to sort of, snuff out, to make it a bit more robust. That's number one. Number two, and again, I'm not going to say any names here, but one of the top 5 banks sent out a mass communication to their, top brokers that they're now going to be looking at, in the mortgage industry, we use a term called TDSR, okay, which means total debt to service ratio. Mm-hmm. So for every dollar of income that you get, what's the maximum debt percentage that you can carry, right? And generally speaking, with most A lenders, most of the big banks, the top 5, it's 44%. Some are a little bit different, but generally speaking, 44. So for every dollar that you earn, your total debt servicing, meaning your car payments, your mortgage, your property tax, your credit card payments, cannot exceed 44 cents for every dollar that you earn. And if you met that requirement, let's say you're at 43.9, okay, and your credit score was above 650, and you were putting 20% down, you're getting approved, no problem. Now what they're doing is they've told us that they're going to be looking at each client profile on an individual basis. So that blanket policy no longer applies to the down payment, the loan to value. LTV is what we call it. So now that is going to be on an ad hoc basis per each client profile. So if you meet the requirement, let's say you're at 43.9% and your credit score is above 650, for example, but you know what, like 5 years ago you did have a missed payment, and let's say your income is traditional, but maybe you had some gaps in employment a year and a half ago, but you meet you check all the boxes, they can still come back and say, oh no, you need 25% down payment, or you need 30% down payment. Sorry, excuse me. So they're introducing this sort of approach to lending at the top 5, which has never happened. So why is that happening? Again, going back to what I said before, they're really tightening up the lending. So
they're tightening it up more, like the opposite of the question I asked. So even though they see the market going like this, they're tightening it up. Do you think the market is going to crash and we're going to have a big real estate crash in 2023? Because you see that headline somewhere, but personally, I don't believe so. But what are your thoughts on that?
I don't think so. I don't think the market's crashing. We have folks in Canada, especially, and I don't know if I said this last time here, we pay our bills on time, right? For the majority, right? And I think that's a big piece. That's an important thing to talk about. The second thing is that the reason why I don't think it's going to crash, number 2, is obviously we all know inventory, right? That's a big issue. You're bringing in 1.4 million immigrants, right? Where are you going to house them? Stats tell us that over 80% of those folks are going to come and live in Southern Ontario. Where are they going to go, right? So at first, what's going to happen is that's going to, put pressure on your rental market, right? And then as these immigrants settle in, and remember, these are not immigrants that are, they're not refugee status, is what I mean. They're coming in, they're skilled labor, doctors, nurses, people. A lot of them are coming with money too. Exactly. They have good income, they have good money. They have good money. IT professionals, a huge chunk, right? And anything in IT that the clients that I'm speaking to have very good income, right? So they have the down payment, they have the income. What's the Canadian dream? I want to buy a property, right? So I don't see why that would happen. Yes, there is something to be said for a slightly higher default rate. It probably will spike a little bit because, you had folks that, bought a property at the peak of the market, and, for whatever reason, they couldn't qualify. Then they had to get a second mortgage on it, a private loan on it. Now they don't have enough equity to refinance those. So yes, we might see a slight uptick in the defaults or foreclosures, but there's way too much demand for that small spike in defaults to have any sort of effect on the market.
Yeah, and those people that got ridiculously low rates, like 2.5, even
lower than
COVID,
that,
right? Like, yeah, I mean those were
1.4,
really like 1.5. What they're gonna have to renew at some point. So what do you think is gonna happen to those people? Because it's different when your mortgage amount is like 400, 300, 500, and it's a whole different ballgame if it's like 1.5, 1 million. So their rates are gonna jump up.
And just the qualifying process, like, are we seeing that affecting those that are coming up for renewals?
So remember this: when you're doing a mortgage renewal, right? Let's make that clarity here. So a renewal is simply your bank is going to send you a piece of paper, and it's going to say, hey, here's your renewal options. Pick one you like, sign here, send it back. There's no qualification that happens in that scenario. That only happens when you're doing when you say to the bank, hey, I need extra money, or I need to re-amortize my mortgage, meaning that Right now I have 23 years left on my mortgage, but I want to go back to 30 years because I want to lower my payments, right? That's when they do the full credit assessment. So that's when they'll look at your income and this whole shebang. All of that will happen at that point. So if you're doing a renewal, you're okay. That's the answer.
I think it was more the affordability I was talking about. Like, what's going to happen if you're paying $5,000? So surely some of those people are just not going to be able to afford it. Do you see that having an effect on inventory as well?
So I think yes, because in certain situations, I think if you look at, let's say if you take an average, and I don't know, I don't have stats on this unfortunately, but if you have 100 people that are coming up for renewal and their payments are jumping up by 25-30%, right? Out of those 100 people, how many are going to be like, oh my God, I can't afford this. Okay, I am going to sell my house. I would probably say it's going to be less than 10%. The rest of those folks will, figure out a way to manage. Yeah, things are going to be a little tough, but they will manage.
The 10%, like they're a house that, like for example, 1.5, you need at least like 350,000, something along those lines, 300,000 down payment. So they have equity in the house. So they could just simply sell and downsize and get like a townhouse or a semi-detached and still be okay. So I think just because the regulate goes back to the regulations with the mortgages and stuff, because it's tight and people can't just not anybody could just buy a house. That's protecting our real estate market fiercely, and also the supply and demand is always going to be an issue.
Yeah. So I think, those people that 10% that will, either sell, and then out of that 10%, there might be the, few cases and be like, oh, there's not enough equity. Like, they don't even have, I've had those calls where realtors have called me and said, hey, we have to cancel this listing because there's not even enough to cover the commission. So in those types of cases, yes, they're going to happen. But like I said, I think that's a very small number compared to the people that are going to be like, all right, it is what it is. And, we'll manage. So refinances, first of all, I'll tell you what's happening in the market right now. Refinance business in Canada overall is down quite a bit because obviously for obvious reasons, interest rates are higher, property values have come down. So the refinance business is down in all of Canada. It is we're starting to see a bit of an uptick, but it's nowhere near what it was 2021 and 2022 was just insane. Like everyone and their mom was refinancing. I want to put a pool in the backyard. I want to build a nice deck. I want to, build a cigar room in my basement. You should have seen this.
Well, people were also
Buy a second
refinancing because their
property and
payments would have been a lot less with the refinancing, and they were able to pull out some cash, right?
Yeah.
Yeah.
So huge
Tax
uptick we
free.
saw. Tax free. So that's not there at this point. So it's a little bit down. But to answer your second question, what the difference is. So a HELOC, otherwise, a home equity line of credit, you can get in second position after your mortgage. So your mortgage is in your first position. That's the lender puts it on your house, and the home equity line goes into second. Now, a home equity line is obviously going to be based on the value of your home. Most lenders cap it at 65% of the value of the home for the mortgage and for the home equity line of credit. In some cases, it will go up to 80% of the value of the home. And it's a great tool to have as a cash reserve for any sort of unforeseen life events. Anything emergency happens, you can get access to some cash, or for sort of debt consolidation, that sort of thing, because it's still a pretty attractive vehicle in terms of cost. So it's a good option. It's better than your unsecured line of credit.
And you're only paying it if you're using it, right? So
Exactly. That's the main benefit. However, sometimes what happens is that I get calls from clients who are like, hey, I need to get a home equity line of credit. I'm like, oh, great, not a problem. What is it for? Oh, I'm buying a second property. Well, okay. If you're buying a second property, then you already know how much money you need, right? Because if you're buying a second property or a pre-con, then I need, $120,000. Great. If you already know that amount, then let's do a refinance, because that's going to be a cheaper vehicle for you in terms of interest rate than to get a home equity line of credit. Because a home equity line of credit is going to be a fluctuating rate. Prime, generally banks, if you're a bank client, you're looking at prime plus something, right? Prime plus 0.5%, prime plus 1%, whatever the case may be. And it's revolving. And revolving debt, as you know, this is the Financial Freedom Podcast, revolving debt is never good. right? You never want to get into revolving debt. So if you're doing it for the purpose of buying a second property or a pre-con, then I would not recommend a HELOC. I would recommend then refinancing. The HELOC, again, is good for, let's say, if you're doing construction in your house, you're putting a basement, because then, you need money in chunks. Oh, now you're going out you're sending your contractor money for this or that, it's more on the go, then it makes sense to get a HELOC. But for anything other than that, I would recommend that refinance is probably a better option for you.
Yeah, I agree with you.
Yeah.
And so what is the difference between those who get fixed rates and variable? And what do you recommend for people right now?
Like if you're getting a mortgage in April or May 2023, where the rates are today, what would you recommend, for some folks out there who are looking, would they get fixed or variable and some things around that?
I would say short-term fixed rates are the way to go right now. Probably I would say a 2-year fixed would be my go-to. So, and again, I'll put my money where my mouth is. So I just did my own mortgage last week. I finished the documents. So I did a 2-year fixed from my bank.
And why do you think 2-year fixed is the way to go? What's your logic behind it?
Right. So great question. So, again, like I said, I like to privy myself with information on what's happening in the market. And my read based on the experts that I've been speaking to on Base Rate is that the banks already have priced in these rate cuts. They already know where the market's going. So, they're expecting a 12 to 18 month cycle when we start to see the rates sort of, come down a bit more on the prime side. On the Bank of Canada overnight rates. So if you look at a 12 to 18 month timeline, then I think it's a safe bet to go with a 2-year term. You could possibly even go 3 years as well. I don't think when the rates start to come down, it's not going to be like, oh, they're 2% lower now. It's going to be a bit of a journey till we get back to the norm. And what that new norm would look like is anyone's guess. But, if I had to take a guess here right now, I think we're probably going to end up somewhere in the high 3s, low 4s is where we're probably going to end up whenever the dust settles from this sort of inflation super cycle. Right. I think that's what I see.
Yeah, I don't see it being a 2.5
rates.
A little bit higher.
No, a little bit higher, because pre-COVID you were still getting like 2.49, 2.69.
Yeah.
So you're gonna be in the threes and fours.
Yeah, that's why I think even the people that got fixed rates prior to COVID are gonna really
feel
be
the
yeah, they're gonna feel it for sure.
Mm-hmm.
Yeah, and
they're probably
but the
up
value
for
of their
now.
property has gone up a lot too. Even if it came down a little, it goes up and down in an upwards way, right?
Yeah.
So
yeah,
there's a lot of equity in properties.
And what we have to I really hope that people look into this. It's very exciting to I want to build a real estate portfolio, but you have to really know, you have to be with a trusted realtor partner that's going to make the right recommendations to you. So I'll tell you a story, and this one is close to me. So in last year, I get a call from one of my clients. Okay, his mortgage balance was under 500,000. Okay, at the time, and his house value, obviously 2022 house prices, his value was like 1.5 million. And he goes like, Bilal, I saw this great pre-construction project, and they're selling detached homes, and I want to pick up 2 units. I want you to refinance and get me 700,000. So I recommended that, hey, I don't think that's such a smart idea, like hedging that much of a risk against your principal residence in future value of something that you think is going to be a good investment. I don't think it's a good idea. And by the way, it was 2 detached homes, okay, 2,400 square feet.
Yeah.
Single garage, 2.1 million each. Okay.
And what are they at now?
I'll get to that.
Where was it?
Okay.
Huh?
Where was it?
Brampton. Yeah. So
this was at the peak of the market.
So my recommendation to him was that, hey, I would not recommend that. Now, however, then I didn't hear from him. Okay. He called me in end of November last year, and said, Bilal, I'm in trouble. I need your help. I'm like, what happened? He's like, hey, I went to, I ended up going to a different mortgage broker, and I got a refinance done. I pulled out 800,000 of equity of my home. My mortgage balance is now 1.2 million. and the homes that I bought, they're coming up for closing,
Oh no.
and the appraisals came out at 1.6.
Oh my God.
And he, he bought 2 units. So
People got really purchase
Well,
happy.
that's the
Like
difference
they
between
just
transactional
Yeah.
mortgage or real estate brokers versus the ones that are looking for a relationship. Like you could have easily just done that deal
Yeah.
and like not worry about what's and not give them that advice and make good money, But instead you told them what he needed to hear, not what he wanted to hear.
exactly, and I think that is part of the I guess this highly speculative market is the type of real estate professional you're working with, whether it's realtor, whether it's your mortgage broker, whether it's your lawyer, right? Because if you're using someone just for the transactional value and they're just selling you the hype, that's when you can get into trouble.
Yeah,
like
you can.
like this gentleman.
And they
you
gotta
know,
be
like,
investor focused too. Like a lot of people work with real estate agents that don't even invest in real estate themselves. Like they're selling them investment properties, but
And
they're not
do it,
investors.
yeah.
Or mortgage brokers who get investment mortgages, but they're not even into that. Like they don't do investments. So you gotta work with those who are actually investors and work with investors because they know how to structure these deals and do things in a way that's
Especially the ones who have made mistakes early on.
Yeah.
They know what to do, but
they know the risks too, right?
Yeah.
Like the people that don't invest themselves, like they don't know the risks, they don't understand the risks. So how can you be telling someone else to take those risks if you don't do it yourself, right?
And I also think that there's something to be said for specialties in even in realtors, right?
sure.
So like for example, I know you're amazing at pre-cons. Like that's like your forte, right?
Yeah, without precons.
That's your specialty, and there's nothing wrong with that, right? Like, and yes, of course you can do other residential transactions, you can do everything, but you enjoy to an extent doing pre-constructions, and you're
Right.
very knowledgeable in that. So if I were to come to you and say, hey Sam, I want to buy a commercial property in Saskatchewan, can you help me with that? That's probably not a good idea, right? Not to say anything about your ability, but that's not your specialty,
Of course, yeah.
right?
Yeah.
Can't be everything to everybody.
You can't be everything to everyone. So I think you really have to, really dig deep and, ask that question of your realtor that,
Yeah.
hey, what's your specialty? What do you specialize in? And your mortgage broker too. Hey, do you only do like residential? Do you do commercial as well? Like, what's your take on this? So you really have to know who you're working with.
I agree. There has to be a set of questions you need to ask people, even real estate agents. Like, there's a lot of us, but there's a small percentage doing most of the work.
business, right?
And, like back to, you saying a lot of people are transactional. It just sucks because when I hear stories like that, I'm like, that could have been done to somebody in my family. It could have been done to my mom, to, a cousin or somebody in my family, a friend of mine, and that would have sucked. Like, to take out 800,000 and then now the 2 homes are worth 1.6. I mean, I don't know. I'm pretty sure
Well,
the
they were,
mortgage
like,
broker wasn't
betting on
purposely
the
doing that,
upside,
but
right?
it's a gamble. Like some investments have to be done.
Sometimes people
calculated.
just need to learn the hard way too, right? Like you clearly told them not to do it, right? So they learned an expensive lesson, and hopefully like they can turn things around. But sometimes you don't need to learn. You don't need to pay that much for a lesson.
For
Yeah.
a
It's a
lot
mistake,
cheaper.
right? Like,
Well,
and-
people get excited, like I have a client who I met after the fact, but she went and bought a ton of properties because she was flipping them. So everything was going really great when the market was hot, buying them, renovating them, flipping them,
Right.
making a killing. And then as soon as the market stopped, she had a bunch of properties she was stuck with, and she can't do anything with them now because they're worth a lot less. The cost of material is
Has
up
gone
the
up.
roof.
Yeah.
Contractors are nowhere to be found. So she was screwed. So
that's a tough one, and that's true. You really, and you should always diversify. Like, don't put your eggs into one basket. And I do apologize. Like when I was mentioning that gentleman's story, the lesson there was that you should be really focused on your income, right? These one-off, home runs, yes, they do happen, but they're few and far between. What you should really be focusing on, hey, if I'm pulling equity out of my house, how can I use that to increase my income, right? And then when my income goes up, then let me look at a second property or a rental, or what else can I do in real estate, but you have to really be careful of
Yeah, you
that.
can't over leverage yourself.
Exactly, and now you've over leveraged your principal residence. I mean, come on, like that's
Your
that's
family,
your that's
yeah.
your family, right? That's your home,
Yeah.
right? Don't gamble with that. Don't gamble. That's taking a gamble. Like, would you go to a Casino Niagara and put down the deed to your house and say, "Oh, let me play some roulette here"? You wouldn't, right? Same thing in that. Like, how could you do that, right? So that speculation, and this is where I think there's also a cultural aspect to it as well. And I think a lot of, because Toronto, especially the GTA in general, has a high immigrant population. We have very good diversity, and it's like. If a lot of folks, they see that, oh, my relative came to Canada in 15 years ago and now they have 6 properties and they're multimillionaires now, I'm going to do the same thing.
Yeah.
Right. Well, they came at a different time. Things were different then. Mortgage qualification was different then. Buying a home was a lot different then. And so you have to take those into account. So get your own house first, pay that off first, or at least get in a very comfortable position where you've increased your income and you cash flow positively really, really well, and then look into, okay, how can I now start building my real estate portfolio? Maybe pre-cons are better for you.
Yeah.
So you really have to vet that.
Yeah, it's not a one size fits all. You got to do your research, and if you want to become an investor, it's not as easy as people think. Like to really scale and do it successfully, you need to educate yourself to see what's the best fit for you, how you're gonna go about it, plan it out, and things like that.
Yeah.
What about like new investors or those looking to get into real estate investing? They don't necessarily care to have a matrimonial home or a family home. They just want to make money from real estate.
Yeah.
What is your advice to them on how to structure themselves in a way to make sure that they're successful in the future? Because a lot of times we start doing something and we don't realize what we're doing, and then 6 years down the line we're kind of like looking back and thinking, oh, we should have done it this way, we should have structured it this way. How can they set themselves up for success?
Right. So first thing I would do is I would make sure that I have a good team. Okay. And by team, again, I mean you have a good real estate agent, you have a good realtor working with you, you have a good mortgage broker working with you, you have a lawyer, and then you have a financial advisor. Right? Once you have those people in place, right, that covers all of the bases, right? It covers your tax strategies, through the financial
Huge.
advisor, which is massive.
Huge.
I'm sure I can talk about holdcos here in a minute. I'm sure you guys know how those work, holding corporations.
Yeah.
So tax strategy, it's great to invest. Actually, I'll say this on record here. So when I did my first pre-con and I sold it, I was ecstatic. I'm like, this is great. I made good money. Yes, I'm gonna go and buy myself a Porsche. Okay. But then my accountant's like, hey, you have to pay capital gains tax on that. I'm like, why didn't anyone tell me this before? Right? So get educated, get a financial advisor. Okay.
How much did that hurt though?
It hurt quite a bit because
Oh
I
my
did not
God.
factor that into into my calculation. So I couldn't get a Porsche. I ended up getting never mind. I had to get an older Porsche. How about that? But no, all jokes aside. So you got to have a financial advisor in your corner. You got to have a mortgage broker. And of course, an expert realtor like you guys that can show you that, hey, this project is better than that project. And here's the reasons why. So those are the basics. Then I would look at what's my investment mix, right? If I have $100, do I have entire $100 invested in real estate? Or is it like I've got 70 invested in real estate, 15 in whatever, and then 10 in the markets and 5 in crypto? Okay. Yeah, I did say crypto. That's right. I did. Even though everything is down, I did say crypto. So, you got to look at your investment mix, right? Like, what's that looking like? So you got to assess that for yourself.
Right.
And then the most important piece to that whole equation is, look, no one has a crystal ball, right? So no one can predict, Sam, as great of a realtor as you are, I'm sure you can't tell me what that house is going to sell for in 13 years and 7 months.
Right.
We don't have a crystal ball. So you have to prepare for that aspect of it, the risk appetite. Like, what's your risk appetite, And then once you have those pieces in play, then you can step into the market and start investing. So that's would be my top 3 things that you should really focus on if you want to get into real estate investment. Any real estate investor that I know, the good real estate investors, again, like I said, they don't have, if they have $100 available, their entire $100 is not in real estate. There, might be $70, $75 is in real estate, but the rest is they've diversified it in other markets, capital markets, whatever the case may be.
And they're playing the long game too. Like they're not really speculating or just playing the short game.
Long game, absolutely. And thank you
You
for
gotta be
bringing that
patient.
up. Absolutely, it has to be long game. You cannot, if you get into real estate for short-term flips, one point or another, you are going to lose. You are going to
Yeah,
lose.
well, your time in real estate will just be short term.
Exactly.
That's it.
Well said.
Yeah.
Well said.
And the thing is, like, this what we're experiencing right now is as normal as the peak of the market. This is all just gonna keep going like this, but on the upside, right?
Yeah.
Just keep going up. But we're gonna have dips. That's pretty normal.
Yeah.
We were just in a very reactive society, but
Exactly.
yeah.
So I think that's what you have to really look at. And then if you look at like macros of the market and you see what the smart money is doing, and I think when I was here last time I spoke to you about smart money. So I generally try to follow the smart money. Where's the smart money going? So there's a lot of money. Like I'm talking billions of dollars. That's billion with a B. Billions of dollars that's coming into Canada in our real estate market from the United States, right? From the UAE, okay, China. So there's a lot of smart money, big money that's coming into our markets. Now, I don't necessarily mean, and when I say this, people generally tend to think that, oh, they're buying houses. No, they're getting into lending. They're pumping money into, financial institutions, private lending, private funds, hedge funds. Like they're pumping money somehow to connect themselves to the real estate market in Canada because we know it's very robust. It's very, very regulated, and it's a very safe market with a good upside. So I think those are key
Those are good
indicators
signs, yeah.
of how the market believes that the Canadian real estate market is very strong, and it's a market that you can definitely invest. Again, as long as you're thinking long term,
Yeah.
you're going to be okay.
Yeah. Absolutely.
That's some awesome nuggets right there to wrap this up. Thanks so much, Bilal, for joining us again on this episode.
Thank you.
And thank you guys for listening to the Financial Freedom Podcast. With that said, if you guys want to follow Bilal and his team, we're going to put the Instagram handles for 812 Mortgages. Thanks so much again
Thank
for
you
coming.
so much.
Thank you so much
Appreciate
for
it.
having me. Appreciate
It's
it.
great.
Thank you.
Thank you.
Awesome. All right.